Good morning, traders and investors. My name is Roger Scott, and I'm the senior strategist for WealthPress. Today's Friday. It's August 5th. The first week of August is already behind us. It looks like it's time for kiddies to start thinking about going back to school. I'm taking my last summer trip to Washington, D.C. I'm leaving right after this video, but I'll be back on Tuesday, and I will be doing my videos from Washington, and I'll be working from there. So you'll be seeing me. I don't think you'll be missing me too much because I will be around. I'll be checking my emails. And please, 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 if you guys are getting any benefit from these videos, if you're enjoying these videos, if you're making money from these videos, if these videos prevent you from losing money, send me an email or post a comment. My email is support@marketgeeks.com. I'd love to hear from you. It's been a while. So S&P 500 kind of flat, NASDAQ a little down, the Dow Jones is about up 40. This is definition of randomness. This is very, very little directional bias. I think the market is waiting for the employment report that's coming out in about 36 minutes, to be specific with you. I like to be as specific as possible. I'm not really focused on the non-farm payroll number. As you can see here, it's kind of all over the place, and I think we will hit somewhere between 250, 275,000. I'm more concerned about the unemployment rate. I want to know if it's moving higher above 3.7% or if it's cooling off and it's going to be within the 3.6% target. I also want to know the private payroll number, because this is very, very important right now, because look at this number, 190 to 280, it's all over the place. So it'll be very interesting to see where the number is, but the consensus here is 3.6% unemployment, 250 non-farm payroll, and then private 220. It'll be very, very, very interesting to see also manufacturing. This will be a good number. Now, as we pay attention to this, you want to keep your eye on the bond market. The bond market right now is near the 119 level, and let me just go short term. It's been bouncing between these areas, the 109 on the TLT, this is the TLT, not the futures, and the 120, and I think it's going to remain in this range, and I think it's going to keep the stock market range bound for quite some time. In terms of global economy, let's talk a little bit about global economy, and then I'll back into the indices. Ooh, what happened here? I thought I did. Here it is, my highlighted version. Look at that face. She looks like she's seen Pelosi in China, right? Don't get me started. So, world futures were mixed Friday ahead of the update on U.S. jobs market, while the Federal Reserve waited. More rate hikes are needed to cool surging inflation. We definitely need more rate hikes. The question is when and how much. Investors are looking ahead to monthly U.S. employment numbers. That's what we discussed right now, for possible signs of weakness that might prompt the Fed to decide it needs to ease off the rates. If employment is solid and if people are spending, they're going to keep going as far as they can. And they should. That's what they should be doing. The Fed has raised its benchmark twice already by 0.75, 3 times its usual margin, and the biggest rate hike since the early 1990s. And what does the bond market do? Look at that. It doesn't go down, it doesn't go up, it just stays sideways, which means most of the turmoil is priced into the market. Economists worry that signs of weakness are starting to turn up in hiring, threatening one of the United States' last remaining doubts. I like this word, doubts of economic strength. That's a word I got to use more often, doubts. Or redoubts. Is that a real word, redoubts? Job openings are down. Number of Americans signing up for unemployment is up, but it's not that much up. Let's not overreact to this. The number of Americans who applied for jobless benefits rose last week by 6,000 from previous weekly 260,000. That's not a big number, folks. Not even close. And energy prices are starting to come off. Speaking of energy prices, here is where we are, and I'm getting very nervous about this, because for the first time, energy prices are now trading below the start of the war levels, and it looks like we're continuing this downtrend. So right now, we're still at the 200-day moving average, but if we start breaking below the 200-day moving average, it's going to get very, very squirrely, and I'm going to get very nervous that the energy might have topped out. Not sure if that's the case yet, but again, let's keep our eye on the 200-day moving average, and let's see how the bounce from this area is going to be, and whether the low here will be higher than this low. Let me set a little trajectory here for you, like that. So if we stop here and then start coming back up, it'll be okay. But I'm very nervous about the fact that we went up to the 50-day moving average and we bounced back down to the 200. I'm not happy about that, and that's a bearish sign. That's not a bullish sign. So right now, risk on with the energy market. Very, very, very important. Now, going through the sectors, and we got to go through the sectors, right? Right now, folks, utilities is leading, but look at what's after utilities, technology. That makes zero sense. So either utilities is going to bolt down and technologies is going to rule, or utilities, energy, industrial, healthcare is going to rule and technology is going to start slipping. Now, technology is up because for the last month, technology and consumer discretionary have been the strongest sectors. But I'm going to tell you something right now, and I've been telling most of my traders there, I don't think this is permanent. I think this is temporary. I think this is too much too fast. I think this is a grossly overbought market, and I think we're going to cool off and go down to the base on tech and on consumer discretionary, which means back down to this base. It's too much too fast, which means the odds are technology and consumer discretionary will start coming off, and defensive stocks, which are leading on a multi-term basis, like energy, utilities, industrial, healthcare, consumer staples, are going to come up again. But right now, what you're seeing is a very, very, very fragmented market. First of all, you've got technology and consumer discretionary apart from each other. You've got utilities and energies apart from each other. Healthcare, consumer staples seem to be next to each other, but you got communication services and technology and communication and consumer discretionary all spread out. I mean, communication services, technology, and consumer discretionary are not all that far away from each other. So this is a very, very fragmented market, and typically fragmented markets cool off by going down, not by going up. They get defragmented by going up, and they get put back in its place by going down. Also, if you look at the NASDAQ, I mean, we are still in a downtrend. I mean, it's been a while since we peaked out. So the way I'm looking at things, I would look at this as a overzealous rally from a pullback to the downside. I wouldn't look at this right now as a reversal of a trend. I would need us to see trading above the 200-day moving average. If you look at the Dow Jones doesn't even look that strong. The Dow Jones, look at that. It's a downtrend. And let me show you something else. I think I can almost connect these. No, it still can go up to the 200-day moving average and still can be in a downtrend. So before we get bullish on any of these indices, I want to see us trading above the 200-day moving average. Till I see that, all of these gyrations, like in technology, in consumer discretionary, this is just overreaction to positive earnings, and I think we're going to cool back down. Now here's the interesting thing. If all of a sudden, miraculously, the economy starts looking like it's gaining strength, and I don't think it is right now. I think it's just kind of hovering. I think these will continue, but honestly, in my opinion, and I've been doing this for a long time, this trend in consumer stocks and technology is a little overdone, especially when you see communication services trending like this. This is what I would be expecting to see right now. This is too much too fast. I mean, this is like a 40-degree slope right here. And obviously, if this is strengthening, you're going to see a downturn in energies. But again, till we break the 200-day moving average, I wouldn't rule out energy prices, especially with consumer staples and healthcare slowly moving higher, which I'm very happy about. So I think we're going to see another turnaround, especially as we finish the summer off. I think what's going to happen is the summer is tricking a bunch of speculative traders back into the market. And I think ultimately, look at the small caps. Small caps are far from the 200. I think this is going to turn around and come back down. And this is going to cause volatility to rally, which is one of the reasons why we went bullish on volatility yesterday. I think volatility has had it, and I think it's going to start turning around. It looks like it's bottoming out around these areas. The 5-day RSIs, I'll show you right now, is kind of to the downside. And what I like about this is it's diverging. Look at that. Look, the lows are getting higher. I love that. I love when the lows are getting higher. Now, and here, the lows are getting lower. So this is a classic divergence sign, which probably means we're going to turn around. So I'm looking for the bond market to start cooling off once again, meaning TLT, or if you look at the futures, I'm looking for bonds to start coming down a little bit. I'm looking for volatility to start coming up a bit. And I'm looking for XLY. I'm trying to be as clear as I can with you guys. I'm looking for XLY and XLK. And obviously the NASDAQ 100 to cool back down. To go back into its base. I think this is too much too fast. They've been following the bond market, and this little hiccup here is because earnings were better than expected, but most of the earnings were better than expected because they were estimated so low down here. So I think we're going to have a little reversal, and the market's going to remind us and humble us a little bit and tell us that we're not over just yet. And let me tell you, I want this to be done with, and I think we're about 60-70% done with, but I think we're going to stay in this range or thereabouts this range till about midterms. This is a very positive sign. It looks like markets are starting to move in the right direction, but it still looks like we have a lot of pressure behind us. So it's time to get a little more defensive, time to focus on speculative stocks, time to take profit on your tech and consumer discretionary stocks, and remind ourselves that we still are in a turmoil type of market environment. Now, I want to show you something cool. This is our pattern trader tracker. You know why I can't do profit factor, why this is squirrely here? You know why? Because in order to have profit factor calculate accurately, you have to have losers. Well, we have 11 trades. We actually put on a 12th trade, PFE, but we're open right now, so I can't tell you if it's a winner or a loser. But these 11 trades were all winners. They were all winners, and you could see the entry date, the exit date. You could see the win rate right here on the historic profit factor. You could see the name of the pattern, and you could see exactly what's been going on. And we've had a 100% win rate, real issued trades. And here's the type of candlestick it is, so you can see exactly what it is. So I want to go through this trade with you because this COF trade that we closed out for what do we close? I don't even have the winner. They didn't put the winner here. I think it was 17%, but let's take a look. I want to kind of go through this with you and show you how it all works. So I want to break down this trade, Capital One. It was a bullish harami. It's a reversal pattern. Here it is. Here's how it's signaled. We had a bearish candle. The next one was a bullish harami. It had a reversal on July 27th, not too long ago. And again, if you want more details on this, follow the link below. I have a full presentation. We entered on July 28th, right here, just a few days ago. We exited when the close was set above the previous day's high, which just happened to be the next day, right here. And we got out for a juicy 36% gain. So we bought the September 110 strike price call, and we got a 36% winner overnight. So you have the full picture from May 23rd through August 2nd. We've had a 100% success rate. All the trades, the 11 trades have been winners, and our average return has been 17%, and the average hold time has been 3 days. And again, I can't calculate this profit factor because we haven't had a losing trade yet. Once we do, and I'm sure we will, we'll have one. Right now, we're in Pfizer, and it was up last night. We'll see how it does, but I wanted to give you a little idea about Pattern Trader. Now, if you missed Pattern Trader strategy training session yesterday, there's a replay link below. We covered all 5 patterns that historically on the S&P and the NASDAQ and stocks work extremely well and have helped me go 11 for 11 since I started using this strategy. Not every trade is going to be a winner, of course, but it really has become my favorite way to trade this market. I just love this, especially in this crazy market. Just click the link below, watch the replay, get the details on all 5 patterns. And I mean real details, real research, meat and potatoes, no monkey business. Follow the link below. You're going to love this. It's not market dependent. It doesn't matter if the market's bullish or bearish. We're in the trade on average of 3 days. Here, you could see here, entry date, exit date. You could see here, Just a few days, 20, 25th, 13th, 14th, 5th, 7th, 29th, the 1st, 24th, the 27th, 22nd, 24th, 17th, 20, 3 days. And we even give you some bonus trades in there as well. Follow the link below. You've got to check out Pattern Trader. It's really, really cool. You're going to love it. Where else can you find out before taking the trade the historic win rate of the system you're using and the historic profit factor? Pretty cool, right? I mean, winner or loser, you get the equity curve and everything. You guys are going to love it. Check it out. Do it now. Follow the link below. Have a great weekend and send me some love letters. I want to hear from you. I haven't heard from you in a while. Support at marketgeeks.com. I'm going to get teary-eyed. Send me love letters. Bye, guys. I'll talk to you later. I'm just messing with you. Have a great, great weekend, and I'll see you on Monday. Bye.